real estate, again, is a long-term play. We always push this. It's not a quick and flip. I should coin that, quick and flip.
I think it's quick flip, isn't it? Quick and flip doesn't quite. Jay, quick flip or quick and flip? I don't.
No, quick flip.
I think you threw an unnecessary
that sounds better
N
as
in
well.
there, my friend.
I'll cut that bit.
Yeah, cut
sounds
that.
better. Yeah. Okay, are we recording? You ready to do this, Chase?
Oh yeah. Looking for a little adjustment.
Little lever to come down. Oh, there's
Nothing.
not one. Okay, we're ready to roll. Yeah. Welcome back, ladies and gentlemen, to this week's Sharp Stories. As you can see, this is not Jay. Chase is back not once and for all. Chase is back again.
For a second time, yeah.
For a second time, here we go. Surprise, surprise, Jay's on holiday.
Yeah, what's he, camping?
He is camping, which is ironic because I can't imagine Jay camping.
He's he's glamping, we'll say.
Yeah, glamping's probably the right word for it. But we've got a bit of an interesting topic today. And I mean, we've had this conversation off camera multiple times before, but the market is now at an interesting point when you're looking at buying versus renting. And for those of you who don't know and haven't been keeping an eye on the rental side of things, the pricing of rentals has just gone through the roof. Like, is that year over year what we'll be looking at?
We're looking at like 20%, up 20% for one beds in Greater Vancouver and 27% for two beds. Pretty substantial.
That's
halfway
massive.
through the year.
So the average price then for a 2-bedroom rental is now $3,600 a month.
Yeah, steep.
In Vancouver, and even I've seen those in Burnaby, like Brentwood, for example, like high 2000s for a 2-bedroom, which is 750 square feet, is not a shock. So it's gone absolutely through the roof, which now kind of begs the question. A lot of people would say, well, it's better to rent. Obviously, we're not taking into account things like maintenance fees,
property taxes,
all of those types of things. Yeah.
Repairs, Home Depot trips, all the things that really, they'll start to add up, which you may not think of when you're originally getting into the conversation of renting versus buying, right?
1,000%. But now I think with these, it creates a bit of a different conversation now with these rental prices so high. And the other thing to point out is, even though the prices have gone through the roof, we're still sitting at a very minimal vacancy rate for rentals. Like usually Vancouver, we hover around, sometimes a little bit above, a little bit below that 1% mark. So the demand is there. It's not like people have no choice and so they're having to do this. If you're putting a rental out there right now and you're actually putting a competitive price, market price, it's likely you're getting calls off the hook left, right and center. And this is not something which is unusual for Vancouver. So I don't see where that incentive is for rental prices to come down in the same way that we maybe do for property prices in Fraser Valley, for example, like houses. So it's almost a harder and dangerous game, I think, on the rental side of things than is the buying side right now.
A little bit, and that brings us into security, right? So as far as rental goes, let's say you have a family, you're living in a property, you're on a month-to-month tenancy, they decide that they want to sell the property, or maybe they have to sell the property because they're over leveraged and they need to liquidate an asset, right? You are now thrown back into the rental market where perhaps your projected increase of rent maybe 1.5% per year, that doesn't apply when you're put back into the free rental market. Now, whatever the rentals have gone up for over the time that you've been renting, you're gonna have to pay now. Are you gonna be able to find a property in the same area? Are you gonna be able to live in that area and even afford in that area, depending on how much it's gone up, 27% perhaps since before you started renting? And are you gonna have to add to your commute now if your kid wants to stay in the same school, maybe 30 to 45 minutes each way? If you owned, maybe you wouldn't have, well, not maybe, you would not be going through that.
Yeah, you've got more peace of mind. And to your point as well, Canadians overall, we're very highly leveraged. So that is very common. But I have I've got some interesting numbers to put it in perspective for you. Okay, so what I did for this is there's multiple 2-bedroom homes in Vancouver from the range of 500,000 to say $1 million. So I kind of took in the middle. I went on a little bit on the higher side. So I've based this on like an $800,000 property. So kind of in the middle, but a bit on the higher side because we're in Vancouver. There are 126 listings at the moment that are active on the market for 2 bedrooms under 800,000 in Vancouver.
Okay.
That's east and west. Inventory levels are pretty low as well, so it's not like we're seeing an influx of these properties come into market. If you were to purchase one of these properties, say for 800,000, you put 20% down, and you just went with a standard fixed-term mortgage, 5.34% with RBC or TD, the payment calculator works out that you're going to be paying around 3,800.
Okay.
That's probably going to change and become higher now because of the new announcement this morning from the Bank of Canada. It's gone up, 100 basis points, so it's gone up a full percent. But that's on a fixed term mortgage of 5.34. So you're almost at pretty much a level cost with what it is to pay your mortgage versus what it is to rent. Mm-hmm. Now, there are things like maintenance fees that we're talking about. You have
insurance, to pay,
property taxes, insurance. If you were to go on a standard 5-year variable, that brings your premium down to about 3,100 with those same companies. And RBC and TD typically hold the most mortgages out of any bank in Canada. 3,100 is your mortgage. You can have your maintenance fee and your property taxes on there for all ending up very close to what you're going to be paying rent-wise for a 2-bedroom here.
Yeah.
That's astonishing. Like we're almost getting to the point where people are going to be going into banks and they will have their, say, 20%, and they'll be saying, hey, I want a mortgage, and and the bank will be turning around saying, no, you can't afford $3,500 a month in our eyes, so please go back to paying your $3,700 in rent.
That you're already paying.
Right? Yeah. That you have been doing for the last year and a half.
Yep.
So I think if you were an investor who owned property and kept hold of it before, like pre-pandemic, or if you bought downtown and during the pandemic, I think you were the savvy buyer. You were the savvy investor, because condos in downtown didn't see a ridiculous rise in price like houses did.
Especially if you locked in a lower rate as well.
Oh, 100%.
Just because of the sheer rental increase. You're coming out on top in this situation.
Well, and all of a sudden you've now gone from even the 1-bedrooms that were around about $2,100 before pandemic levels. They're now up to an average of like $2,500. If you got a 2-bedroom, you were going from 28, maybe 3,000 a month in rent, up to 3,600 in rent by just owning that property. And obviously you would have built some equity on there as well. So let's get Jay on the phone here, because I want to see what he thinks of this.
He's going to be on a pink floaty in the middle of the lake.
Oh gosh, I hope not. I've seen some things from that man that I never
cut to Jay in a Speedo.
Nobody needs to see this.
We're recording, Ben?
In standard Jay Gordon McInnes fashion, he doesn't answer the phone. We're recording, by the way, so.
Hello, how are we?
Good. I need to make sure that I capture your voice on loud. How are we, sir? How's camping?
How are we?
Yeah, good. We're fine. How's camping?
Good, but it's windy. I'm in the car.
Sounds glorious. Oh, there we go.
That's it.
Okay, so I don't know if I informed you, we're talking about renting versus buying at the moment. So here's a question for you, curious what you think on this. If you were to purchase an $800,000 property,
Yes.
Downtown Vancouver, say it's a 2-bedroom condo. You put your 20% down,
Yes.
and you're paying a 5.34% interest rate. Your mortgage works out at roughly around $3,800 a month. Okay? If you go on the variable side, that works out roughly $3,100 a month.
Yeah.
What do you think the average rent for a 2-bedroom in downtown Vancouver is? Or I should just say Vancouver.
The average is 2,800.
3,600.
There you go.
So Chase and I were just talking, and you and I have spoken about this before. if you're almost paying in rent what you would be paying for the mortgage, and if you went on the variable route at 3,100, if you're adding maintenance fees and property taxes, you can get very close to all in paying a month what you would be for rent versus all in cost of owning a property. And another key point here, which we've spoken about before, remember when we were talking about you used to have to put down 40 to 50% as a down payment in order to be cash flow positive?
Yeah.
Those numbers...
On a one bedroom in downtown, when one bedroom rent was $2,200.
Yeah.
But yeah.
So now it's, those numbers that we're working out is based on 20% down. So it's become, if you were an investor who purchased downtown during this time or owned property and just kept hold of it, you're the winner.
You will always win buying over renting unless that money is going into an investment that you trust more than the real estate market. It's going to give you the same ballpark return. But of course, the percentage of interest that you're looking at now is historic and probably still climbing as up of that. But that doesn't mean that it's going to be like this forever, and it won't. So people looking at it are looking at it, oh my God, doom and gloom, the rates are so high. But as we know, it's not going to stay like this forever.
Okay, so I'm interested to get your thoughts on this, gentlemen. Now, here's where I would flip this around. I think we're all in agreement that buying is the better option.
Mm-hmm.
Yeah.
If I was, and by the way, caveat this is all based upon if you are, buying is always a better option, basically. But if you're selling a property, it doesn't matter as much, because if you're selling when it's high, you're also buying when it's high. If you're selling when it's low, you're buying when it's low. So this is typically aimed at those, I would say, who are going from rented accommodation, maybe first-time home buyers, don't own something already, and are possibly thinking about what is the best route to move forward. On the Fraser Valley side, though, how much do you think sales dropped year over year in the Fraser Valley? When you think about how big the Fraser Valley is as well. Yeah.
We're saying on the Fraser Valley side, how much do you think sales are down
Year over year.
year over year?
20 something.
43%.
Ouch.
Okay.
The month before, what do you think it was the month before?
34, 35?
30 something.
No, it was in the 50%. It's the third month it's been dropping, right? Which, I mean, arguably, that's already started to have an effect on pricing on the Fraser Valley.
Oh yeah, for sure.
So I would argue this, and you feel free to disagree with me, but if I was looking at purchasing something in the Fraser Valley, I would look at renting first, because I still think there's more to drop in that pricing, and then you can smooth in when you're timing the market, if you will. But I think there's more value there to be dropped. I don't think we're going to see the same sort of decreases in Vancouver and to the same extent as we will do in the Fraser Valley.
You can, that's a strategy. The two aspects of that are how much do you, because you're obviously sitting there thinking, okay, I think it's going to drop. Okay, well, how much more do you think it's going to drop? Mm-hmm. And then if you're sitting with a rate hold that is assumably expiring, and as rates go up, looking more and more appealing, is it worth deploying that money and getting in now on a rate hold that's going to be for, say, a 5-year fixed term, where I think it's very safe to say that rates are going to very possibly continue up, like I said before, till the end of the year, I think, and then come back down. So I think there's still an argument to get in when it's toning down, and you can use that market leverage as a buyer in order to deploy that cheap money that you've got, that rates probably eventually will be down there, maybe, I assume, in the next 5 years, but what's the climate going to look like? But that you can deploy that cheaper money today. So you can, again, if you think the thing's just going to fall off a cliff, and renting still may very well make sense, in the short term. But again, once it turns, as we know, it can be very quick. So are you how closely are you watching if you're trying to again pick that bottom?
Yeah, arguable point. I think there's more to come, and partly because the people who are out there buying right now are shopping on rates that are almost 3 months old, because to your point, they've had those rate holds. So all of these rate increases that we've seen, including the recent one today, we're not going to see the effects of those for another 3 months, when those pre-approvals start dropping off and people have to start taking effect of these new rates. So there's a delayed process, which is why the numbers like the home price index are delayed as well, because they don't reflect the new rates, the new market. And so with the rates continuously going up, even as you mentioned, to the end of the year, we're not going to see the effect of that in the market until later on. So everyone sees the market slowing down now, but that's based on the previous rate hikes. So I think there's more to come, personally.
Yeah, and just to chime in further to the renting versus owning would be, you're saying obviously owning would be the way to go unless you're deploying that capital on an investment that would yield you a higher return. So all of us and viewers watching at home, wherever you may be, can we say that we, at this current moment, know of an investment that we would deploy our capital on that would get us a greater return than the real estate market, let's say over a 5 to 7 to 10 year period? Do you know what you would invest in? Because if not, if you're renting and you're not investing, then of course, if you have the capacity to purchasing would be better for principal pay down as well as long-term investment. Because if you don't have an investment strategy, there's no opportunity cost if you don't have an opportunity to deploy it.
100%. And if you're just sitting with your money and nothing, there's obviously a risk to that. With the opportunity cost, but everyone also has their comfort levels. Plenty of people are just comfortable with real estate. Plenty of people are just comfortable with the stock market. Mm-hmm. Plenty of people are just comfortable buying bonds or inventory for their businesses or whatever. So I think that as long as you've got a plan and are moving forward, that's the best case scenario. A lot of people are going to be more comfortable in real estate, and a lot of people, again, stock market, those are some people look at those as equal, some people look at those as polar opposite investment opportunities. Personally, I mean, a certain degree of comfort level in both of those. Mm-hmm. So it's but the people that are outside of everything, if you just got a lump of money sitting there decreasing at whatever percent you believe inflation actually is a year, yes, there's a massive opportunity cost lost. Mm-hmm. Fully agree.
That money needs to go somewhere, that's for sure. If it's just sitting in the bank, especially at the moment, you're just losing it entirely to inflation. So I think we're all in agreement that money needs to go, but it's just where that money needs to go. And the other thing to preface as well is, I know when it comes to this type of market, a lot of people are saying that the market's going to drop and they're waiting for it to drop, but they usually have wild expectations of where they think the market's going to drop. And there's people going back decades who have lost out in the market over this type of thinking as well, who think, is it going to get to pre-pandemic level costing? I don't think so, personally. So if the market went up in some of the highest areas like 40%, in other areas like 10%, 20%, is it going to come down 40, 20%? No, I don't think so. I don't think that's going to happen. So it's about being realistic with expectations as well as to what you envision the market to come down to, and realizing that real estate, again, is a long-term play. We always push this. It's not a quick and flip. I should coin that, quick and flip.
I think it's quick flip, isn't it? Quick and flip doesn't quite. Yeah. Jay, quick flip or quick and flip? I don't.
No, quick flip.
I think you threw an unnecessary
better
N
as
in
well.
there, my friend.
I'll cut that bit.
Yeah, cut that
better. But the whole point is it's a long-term play. So if you're buying at 10, 15% below what the high was, if you're there for another 10 years, i.e. the long-term play, it's still highly likely that you're going to see an increase on your investment as well. So everything needs to be put in perspective as well. And to your point, whether it's short or long term, if your money's not being put in anything and you're not making any ROI, with the cost of inflation and everything now, you're just eating into that chunk of money more and more and more, and just at the moment losing more than you would normally when inflation sits at around that 2 to 3%.
And if you're a person that's in that position as well, would be, let's say you have the savings, the capacity to purchase a property right now. Is that always going to be the case moving forward? Will things change? Maybe you spontaneously want to buy a new vehicle. People will spend money before they have assets.
Don't buy a new vehicle when you're doing your pre-approval.
Please,
Just
don't.
Don't do it. Don't do it. Okay, carry on.
Jay?
Obviously, yes, don't do that. I think there's a lot of the people that are saying and calling and wishing for these massive drops are yes, just wishful thinking, but they've never seen, like, they're also, even if you're getting large, and obviously I don't think those degrees of drops are going to take place, but large drops, you're still getting them in the current climbing interest rate environment, which a lot of these people don't take into consideration. It's not like interest rates before and the pricing drops, because when the market was climbing, the cost of money was going down, and therefore the cost of everything was going up. Now the cost of money is going up, the cost of everything is coming down. So there's a whole 10 caveats as to why those people that are hoping for that are never going to get that perfect world. So the biggest thing now is, I think to that last point, is whatever you're comfortable with. A lot of the people watching is going to be real estate, and that's principal residence or investment property or whatever. Just get it in whatever you're doing, so it's still working for you. And it may be a lull time at the moment, or continuing to slowly decrease now. But again, as much as anyone thinks they can or should or want to, no one can predict how it's going to turn around, when it's going to turn around, or what. So maybe instead of buying a bigger principal residence, you put it into an investment property and get some of that, like Jay said, that principal pay down going on the investment side, borrow against it after the fact when you're comfortable, again, to get into that bigger personal. There's a million different ways, but just make sure the money's working on some level.
I think that rounds it up quite nicely. Thank you for joining us from your glamping trip, sir.
Not glamping, it's rough out here.
It's a thing now. Ben, you got to salute.
Holding the fort, gentlemen.
I'm not going to salute him trying to act like he's anything else than complete like marshmallow.
We were expecting to cut to you in a Speedo on a pink flamingo on the lake. You disappointed the viewers, Jay.
No.
Line that up, and that is a possibility. All the equipment's there.
Yeah.
Okay, on that note, guys, we're out.
Bye-bye.
He said he wasn't going to salute.
Damn it. I saluted the viewers, not Jay.